Gareth Soloway, Chief Market Strategist at In the Money Stocks, is back to talk about GameStop, or what's left of it, and the trades he's putting on now. Let's take a look at Gareth. Welcome back.
Hey, thank you so much for having me, David. It's great to be here.
Gareth, has activity died down for you? Have you been less busy the last week since last we spoke?
No, not at all. It is as busy as can be. It is truly epic in terms of the runs in stocks. And again, I'm more of a trader and a short-term investor. So, when you get Tilray jumping up 50, 60, 100%, and it drops 50% yesterday, there's just unlimited amounts of opportunities to make money in this market.
Okay, let's take a look at this Christmas tree. There's this chart here that you brought up in GameStop.
Yes.
You got some flack last time you were on the show. You said you were shorting it. The WallStreetBets loyalists didn't appreciate that. But you know what, Gareth? You turned out to be right. So let's talk about that trade you made.
Absolutely. So the bottom line is last time I was on this date right here with this candle here. And I basically said that I shorted a very small amount of shares. And I did that because obviously anytime you get into a position, you have to analyze risk, right? Risk versus reward. Now, the reward to the downside was massive because it was so high, but there was risk. What's to say it wasn't going to go to $5 or $6 or $7 or $800? But basically, I had a very defined level of exit, which was this high pivot here at $483. And I remember saying that to you in that interview, saying, listen, if it gets above there, I'm out. That's a very defined high pivot. It reversed massively. Then you got this secondary update here. Basically, what I did was, this was just fundamental analysis at its core. Knowing that, I remember saying on the show with you last time that how can GameStop be valued at the same as Best Buy? And if this is the new valuation metric, Best Buy needs to be $1,000 stock. So it was more of a matter of putting a very little bit of shares on the line in terms of being short and then just being patient. And honestly, I didn't have to be patient for very long because reality came back in. To be clear, WallStreetBets, awesome forum. But I've seen this thing repeat in history. And I'm going to say this right now, and I'll probably get flack for this too. But WallStreetBets will never again be like it was for GameStop. And you saw this with silver, right? I even watched the show. You had so many guests come on about silver when it was going to open up that Monday morning. And they were all talking about these massively high price targets. And in my head, I'm like, are people nuts? Here's $1 trillion commodity versus a $30 or $20 billion stock. It's night and day. You can't have small money pushing something that's $1 trillion. Otherwise, they could push Apple up to $700 a share in 2 or 3 days. So that created a situation with when it fell, investors got hammered, right? So there were a lot of WallStreetBets newcomers that bought in at $300, $400, $450 on GameStop, and they all got hosed, right?
Well, that's exactly what I was wondering is whether or not that short position you took was a difficult decision for you to make. You shorted at a time when there was a lot of momentum on the upside. Everyone was still coming in at $300 a share. So weren't you concerned that it was just going to keep getting pushed up?
So there was that risk, right? Anytime you take a risk short or long, there's going to be risk of it going against you. But because I decided that this hot pivot here was going to be my exit strategy, then I knew that, listen, this is the max I'm going to lose on this trade. And remember, if you go back to that interview, I only did 60 shares. So, what was I going to lose? 5, 6, 7, $8,000. It wasn't really, for me at least, like for instance, today, day trading, we made over $10,000 day trading. Me personally, a lot of our members, so the risk was very defined. And therefore, I wasn't going to make a fortune on the way down. But when you're taking a lot of risk, you don't want to do that. You don't want to put yourself in a position where you're freaking out because it's going up or down $5 or $10 on a stock that's $300 or $400. And so it was very defined. But again, you saw with silver, it didn't pan out. A lot of bag holders there on WallStreetBets. And then what's even more amazing is Tilray ran amazingly, but it lasted 2 days. And now there's a ton of bag holders there. And I've seen this before. I traded in 2007. There was a website called thelion.com. Some of you guys may still be on it, but anytime the Lion Master posted up a trade, that stock would jump 50 to 100%. And eventually it ran less and less and less because people were getting underneath water. They were becoming bag holders. They wouldn't buy into the same hype. And then in 99, 2000, I don't know, you might be too young, David, but the Yahoo message boards and the Yahoo chat rooms are where the .coms ran. And eventually they stopped running because once you burn enough people in a group, they're not going to follow the posts anymore. And that's, I think, what's happened with Wall Street Bets, or what will continue to happen. It's not to say when they pump something, it won't jump a little bit, but it's going to be less and less over time.
Gareth, you know that meme investing is now a thing, right? It's becoming a trend. We've got prominent investors, prominent moguls in the investment industry betting heavily on meme investing. I'm not making that term up. I didn't coin that term. It's actually being used in media right now. Whatever's trending on Reddit, whatever people are making memes of, that's likely going to jump up. Don't you want to participate in this?
That's a great question.
Wouldn't life be so easy? You just log on Reddit, you see what people are chatting up, making memes on it, and then you just buy it and you get rich. Wouldn't that just
right?
Yeah. What's wrong with that?
So this is the tricky thing about it, is if you can be first in the door or one of the first 1,000 in the door, you're going to make a fortune. Yeah. But the problem is, can I guarantee myself being one of the first people in the trade? Because listen, I mean, look at what happened to Tilray yesterday. Tilray in the previous after hours was $74 a share. By yesterday's close, it was $32 a share. So think about all those people that were like, oh, Wall Street Bets yesterday was pumping this. It was running up, and they bought in at, $50, $60, $70 a share. It's not really working out too well. Now, the institutions have billions to put to work. They can create scanners that can probably pick things up a lot faster than me. And I give them all the credit. I bow my head to them and say, if you guys do it better and you can get in, go for it. Only if I get an opportunity where I can get in the first group would I do it.
Okay, so it's not your competitive edge is what you're saying.
Exactly. Do what you do best. My analysis is chart reading generally, and that's how I make my money.
Okay, let's talk about your competitive edge then. Let's talk about your portfolio. But before we get into that, let's do a quick dive into your macro outlook. So inflation, monetary policy. Can you give us an update? How does it affect your valuations of stocks right now?
Yeah, so that's the big boogeyman to me is the interest rates, right? So the 10-year is bubbling up against 1.2%. 1.2% isn't something that scares me, but it's the trajectory of increasing interest rates. And as much as the Fed can say, oh, well, we want inflation and this and that, remember that the whole reason the market has rallied since 2009 lows is because interest rates have been being pushed down. And so if you're going to see interest rates moving up, there's going to be an unwind that inevitably will happen. I don't know if it's at 1.5% or 2% on the 10-year, but just be aware of that. And, as great as the recovery looks like it's going to be, there's still valuations of stocks that are already pricing that in. So a higher interest rate would bring those names in.
Okay. So are you following Wall Street Bets for your macro updates here?
No. For me, it's economic numbers. From reputable places, and then also my own analysis.
Are you suggesting Wall Street Bets is not reputable when it comes to economic data?
No, if it's economic data reported by Reuters or someone else, then absolutely. But remember, a lot of people can hide behind screen names. We've seen it. I mean, look, there's TV shows about people getting duped into relationships for years, right? About people not being who they are. So just be aware of that. Everyone should be. Is that you don't even know. For all we know, that there's some institutions, billion institutions, that were behind some of the pumps in Tilray or some of these other ones. We don't know.
You said offline real quick. You said Wall Street Bets is dead. What is that? You briefly touched on that. I don't know what you mean by that. I don't know if people will agree with you. What do you mean?
Wall Street Bets will always maintain its millions and millions of people, but the amount of people willing to chase a play and drive it up like a GameStop, that is already diminished exponentially. And you can already see it with silver. Well, silver was a market cap issue. It's just a huge thing. But with Tilray, it had a 2-day run on Wall Street Bets. If you look at GameStop, it had 1, 2, 3, 4, 5 days up. And so you're seeing the amount of runs start to come in. And again, think about it like this, David. If I told you XYZ was going to go up 100% and it went up 100%, you'd be like, oh, you're awesome. The next one, if I told you it was going up 100% and it went up 25% and then collapsed and you're losing money, you're going to say, I don't know if I'm going to follow Gareth on his next trade. And when that happens over and over again, you burn people and you're not going to see the same run. So Wall Street Bets will be there for years to come, but you're not going to get the same momentum in stocks that you did from GameStop.
Well, maybe give people some time, Gareth. Maybe they're just celebrating their returns right now and partying, and then they'll get back into it.
God bless them. I hope they are, man. I hope they took their profits and are enjoying life.
Now let's talk about your portfolio. I asked you to present a few securities that you're actually investing in. walk us through your portfolio construction process, how you pick stocks, why you decide to put XYZ with ABC, and we'll talk about specific names.
Yeah, absolutely. So I basically put together a portfolio that I would feel comfortable with holding over the next 6 months. Many of these positions I have or have exposure to. For instance, I'm long gold. I love Bitcoin, not at this price, but one of the ones I put in here was TBT, which essentially is a long ETF that follows yields to the upside. All right. So when yields rise, which I expect them to, TBT will go higher. And again, you guys, my thesis on how yields are going to go up is there. You're going to see inflation later this year. You're even starting to see it if you look at food and energy prices. Oil prices are up. Soybean prices, wheat prices, everything is rising. Right now, you're not seeing the core inflation jump, but eventually I think that will get pushed through. So TBT is a good, solid play for a relatively safe investor.
So just for the viewers, it's the TBT is approached as ultra short 20 plus year treasury. So when yields go up, this goes up with it?
Yes, correct.
Okay, all right. So that's why it's short treasury, because prices go down. All right, and it's double, so it's leveraged as well.
Yeah. I think because yields aren't going to, you get to move to 1.5% on the 10-year. It's not a massive, it's a massive move in that market, but you need to get a little extra bang for your buck.
Before we move on, what is your philosophy on margin? I know many people personally who take exactly what you just said, except apply it on an even broader scale. So not only do they buy leveraged securities, they lever up their own accounts. So, do you recommend doing that?
Yeah, so I do use some margin, absolutely. But I'm very careful and very aware of the margin rates that you're getting charged, because there are different brokers out there with very high margin rates. And if you're going to hold leverage for a year or so, you're going to hold margin for a year, you may be charged as much as 5 or 10% of that money. And if you're borrowing $100,000 or $200,000, that's a lot of money. So just be really aware of that. I do think leverage can be used smartly. One of the big concerns for me for the market is that margin is at all-time highs. And usually that predates some sort of de-escalation in the market, meaning that you see a drop in the market that's pretty sharp. We saw this in 2007. We saw this in 99. So just take that for what it's worth. And the reason why margin can actually hurt the stock market is because when the stock market, let's say, drops 10%, if you're super leveraged, then you're going to get margin calls where you're going to have to sell your positions when it's down 10%, which creates more selling, and the market can even drop more.
Mm-hmm. All right, let's move on to the next one now. GLD. So you like gold? How much of your portfolio? Can you talk about allocation, by the way?
Yes, absolutely. So I always hold a core 5% of my net worth in gold and metals, silver and a few other metals, and 5% in cryptocurrencies. That's a standard. In addition, I hold additional gold because I like the chart in the short term. So as a swing trade, I am long gold. I think if you just look at the money printing going on, I think it's a no-brainer to just have some exposure here to gold. You're not going to break the bank. I don't think gold's going up 50 or 100% in a year, but I do think that it's going to be a solid mover, especially if the markets start coming in. You want to have this as a diversification tactic.
Wait, hold on. So Gareth, I'm just trying to understand this. Your long yields, while your short treasury is your long yields. You think yields are going to go up. If yields go up, wouldn't that bring the dollar up and bring gold down? I'm just wondering why do the first two trades contradict each other at all?
No, not really. And that's a great question. All right. So I'm looking at yields going up because of inflation. All right. So yields, to me, that's the key, is that, usually people think, oh, well, yields are going up. This is a good thing because the economic rebound, everything's happening, and this is great. But the problem is when you get this massive flow of inflation that I'm expecting, then you're going to get an issue where you have gold also rising. And I also think higher yields is going to drive down stock prices, which will make people more defensive and go into gold as well.
Interesting. Okay, let's move down the list.
Yeah, SCO. Let me talk about this. This is a good one, guys. SCO is a 2 times long ETF. If you go long, if you buy SCO, you're 2 times short the USO, which is oil. And so I've been talking to some of my big hedge fund player friends, and what they've been telling me is that about a month and a half ago, Iran pulled back and said, not Iran, Saudi Arabia pulled back and said they were going to cut 1 million barrels of production by themselves out of the goodness of their heart, right?
Yeah.
So we saw oil rise. I'm hearing from my hedge fund friends that when oil gets to $60, they don't want oil above $60 because it's going to hurt the demand for oil, and they're likely to put back on more supply. So you're right, but literally today you're bubbling up against $60 a barrel. Maybe it goes a little bit above, but look for supply to increase, and oil's already extended. So I expect oil to come back to about 55, maybe even lower per barrel.
Okay. Yeah, because oil has had a good run in the last few months on on expectations of a recovering economy. So I guess you're banking on more the supply side. You're not talking about demand. I mean, don't you think that an economic recovery, that, by the way, we still haven't seen the full extent of the economic recovery, but don't you think that would bring up demand for oil?
Yes. But I think oil prices pricing that in. Usually oil prices, and just like stock prices, price in 6 months out. So, the market's looking at end of year demand for oil with the price right now. And I think, again, you will see increased demand, but you're going to see increased supply dramatically if oil gets above $60. And also you're going to look at this overbought scenario where you need to have some sort of technical retrace on oil.
Perfect. What's IWM now?
IWM is the Russell. This is just a play because I think it's run too much. It's the Russell 2000 ETF. I would be short this because just since November 1st, this is up over 50%. And this is a market of 2,000 stocks, up 50+%. So look for a retrace on this. And again, small caps have had an amazing run. This isn't a macro call where I think all of a sudden we're going into the depression, so the small caps are bad. It's more just a play and saying, listen, in the next 2, 3, 4, 5, 6 months, look for about a 15-20% corrective move in the IWM.
Yeah, I'm just looking at the Russell 2000 components here. The sector with the largest weight is healthcare, followed by industrials and financials. So does this indirectly tell you, or is this an indirect play against healthcare? Is that where some of these smaller tech stocks?
It might be somewhat. Yeah, you could look at it like that. I mean, just basically it's a chart play. So as a technician, what I do is I analyze the chart, right? And I look at a chart and see how extended it is on different, vectors, whether it's RSI or whether it's MACD or whether it's just price expansion. And it's just gotten to the point where it's smart to have some exposure on the short side here to protect yourself from any sort of decline.
Okay, now ITB is a home construction ETF. Yes. Tell us about that.
Yes. And this is kind of going back to the idea that interest rates are likely going to push higher. And even though you have this kind of lack of supply and over demand for homes, as you see that 30-year get above 2%, you're going to slowly start pricing people out of the housing market. So I do think that you're going to start to see a little bit of a slowdown. The housing market has been insanely hot everywhere. I mean, here where I am, all over the U.S., and it's due for a corrective move. But I do think interest rates are going to trigger that. So I'd be looking to be short home builders right now for that interest rate rise. I think you'll see a correlation between the higher interest rates go on the 30-year and how the ITB pulls back.
Yeah, that's interesting. I think, I think logically that makes sense. If rates rise, people will be less incentivized to take out mortgages and whatnot. But wouldn't home builders be more incentivized to provide supply at higher rates, or not?
Yeah, as long as the demand holds up, they will be. But I do worry that the home prices, when you see a 30-year mortgage payment jumping by $500 a month or so, I do think there's going to be a demand destruction issue. Even though we have an oversupply, over demand right now, and that's my big feeling there is that it's just run up too high, too fast on the home builder side here, the builders, and it's got to come back in as interest rates pop.
Well, when do you expect interest rates to climb? I mean, that's kind of the key, right? It's most economists I've spoken to anticipate interest rates to stay low because the Fed can't raise interest rates right now. Everything would blow up, according to them.
Yes, and they're right. Honestly, they're right. They're not dumb. The Federal Reserve, even though I don't agree with what they've done, they're smart enough to know that they have put themselves in a box. And if they even say something, I mean, how many times have we heard from Jerome Powell in the last month where he just will not say, we're never going to, we're not going to raise interest rates. It's, inflation can run hot. We're not going to do it. Well, he knows if he just says one word, interest rates are going to spike. And I've got news for him. It's going to happen anyways. You can't hold down a market of that magnitude as the Federal Reserve forever. And you see the 30 years bubbling up against 2%, the 10-year up against 1.2%. Interest rates are going up because inflation is out there, folks. It is out there, and you are going to see interest rates climb at least back to 2% on the 10-year. And that really, again, when you look at that 30-year and the borrowing costs for someone who's buying a home, it's going to jump significantly.
You're out there to fight inflation. We're gonna call you the white knight of inflation hedge. That's
I wish I could
term.
fight it and make it not happen, man, because it's not good for the small part, the lower and middle income. I mean, especially think about, how much money is someone spending, someone in just above the poverty line or right in that range spending on food and energy. I mean, that's most of their paycheck. And it's sad to see the Fed saying, oh, well, let's just have overinflation for a while, especially when it's already there.
I have one more question about inflation. Now, are you talking about just headline inflation that includes energy and food? Because you're short on energy, so you anticipate crude oil prices to go down. Wouldn't lower energy costs bring down inflation, Gareth?
Yeah, so the idea is that if energy prices come in, right, then the energy side of the inflation would come down. And I do think that'll happen a little bit, but overall, there's no way that inflation with the money printing overall is not going to come in. So keep in mind, these are trades for the next 6 months. Mm-hmm. Oil has gone up. I'm expecting Saudi Arabia to increase supply. That's where that trade is coming from. Mm-hmm. In the longer term, I think we're going to switch to EVs and alternate energies as well, which are going to put pressure on oil. So I think that's where you get that side of a pullback in oil expected in the near term here over the next month or so.
I was going to say, I don't see short Tesla on that list, but that's okay. We've talked about that.
No, but I am short Tesla. You know I am.
All right. Let's follow up again. We have many more trades to talk about. Thank you very much for coming in today, Gareth.
Hey, thank you so much, David. It was truly a pleasure.
Pleasure to have you as always. And thank you for watching Kitco News. I'm David Lin.